Hey, it's Richard with Matthews Wealth Management. We're going to be doing the end of April's market update. I've promised all clients I'm going to make these shorter so that y'all will want to watch it. So let's just jump right in. The big thing that's changed over the last month here is we've gone back to the bubble of growth. So if you notice, we go 257, 356, 543. Small cap's kind of weird right now, but we have seen basically more money printing, and a lot of this comes from the infrastructure bill that's being proposed and just starting up the printing presses again, which we'll end this segment with. If you go into international, emerging, pretty much everything's positive. That should kind of show you this is inflationary. So we're expecting to see additional printing really driving a lot of this. But we do get a little bit of a story in the 3-month and year to date. And we made a lot of changes back at the end of February. We went long in some of these areas that have done well since. So we can start to see those differences and discrepancies. I think it shows up equally in both. So 7 versus 14, our values have definitely panned out. We moved a lot from growth to value as a rotation there, and it's panned out on the year to date and then also since February. You can also see that in mid caps from 4 to 21. 4 to 21, the exact same thing. And then in growth on the 3 months, -1 on the small caps, 25 on the values. So all of that we did in February, perfect. That's what we wanted it to accomplish. Now it looks like it might be starting to go the other way, so we'll just stay tuned on that for equities. International is nice and boring. Tips, we went very heavy in tips as well as long-term bonds, which is very odd to do. And if you've been in these quarterly meetings, you know that I'm explaining it in a very strange way as to why we're doing that. But it has panned out. We've got the 2% in the last month, 1.5 there, and then we're pretty much flat on short terms and intermediates. So we went ahead and let the long terms take their big hits before we bought into them, and it's starting to pan out as we start to look at more money printing, potential of negative rates, etc. Real estate is still pushing on strong. High yield's nice and boring. Real estate I expect to crash as soon as we have the evictions and foreclosures. Gold had a little bit of a bump on a rebound. We're still down year to date. Go figure. Oil's taking off again, up 31 year to date. You can see S&P a good 13%. If you look at the last three, 11.8 cents. It was a good month basically in general for everybody in S&P. Dow Jones 3, and we're about 5.5 since the beginning of the year. So let me just jump into our numbers real quick. Our best account is up 33% year to date. Our worst is down by about a little under 0.5%, averaging 4.47. Not super happy with that since we're always looking at moderate performance with minimal risk. However, it is just a little bit of a timing issue. There's some additional sectors that are playing into that a bit, not a ton, maybe. We're still missing about a 60 basis points, 0.6%. M2 money supply we're tracking, and that's been we're still printing, so this is the proof in the pudding here. The last month we printed another 1.25% in terms of dollars in circulation out there, so we're now at $19,896,200,000,000 that exist out there among the 330 million Americans. So you could do that math. Year to date, we've got a positive 2.67% inflation. Awkwardly enough, this is as of March 1. They haven't updated it yet to show us April. So again, that's kind of the whole point. They discontinued the original M2. Now they're not really updating the M2 SL, which was meant to replace it. Go figure. So I went ahead and said, okay, there's year to date. Let's look at the 1 year because they showed us those numbers. We're up 24.24%. And if we go since January of last year, we're at 29.11%. And back then we had 15 trillion as opposed to almost 20 trillion. So that's where these percentages are coming from. So a lot of money printing, a lot of inflation, a lot of asset prices just taking off because there's money to invest. And we'll just keep playing this long-term bonds, the value rotation, as well as the tips, and see if some industries take off. Hope that was short enough, and we'll see you next time.